Hey folks, so I'm starting a new playlist series. It's going to be called Income Statement. And for this first video, I'm just going to be talking about the basics of an income statement. So let's just talk about this first point right here. So companies will have different fiscal year ends. Now, sometimes, or probably many times, y'all have gone over to a company's earnings and you see that they're reporting Q1 when we're in Q3. So you're like, what the heck is going on? Why is their fiscal year different than our calendar year? So there's several different reasons for this, but I'll go over two examples. So the first example. So a lot of companies, they work with governments and they're basically getting their money from these contracts. So these companies are likely to follow the government's fiscal year, which is going to end on September 30th. So that's one example. Now, another example is going to be retailers. So retailers report their strongest quarter in the December quarter, so Q4. So a lot of their year-end reports are going to be in January. So in January, we have a series of earnings, and this usually happens in the end of January. So that is when many retailers are going to report their year-end. So they're likely going to follow our calendar year. Now, let's just talk about the very basics of what you're going to see in an income statement. So at the heart of it, all companies, they follow the same format where you have revenue, which they call the top line. So revenue, they call that the top line. And then you have expenses. And then after, you take away the expenses from the revenue, you have income, which they call the bottom line. So this is the very basic format. If I had to really simplify it, it would be these three things right here. Now let's look at something slightly more complicated, but still very simplified. So let's just increase the font right here so you guys can see this a little better. All right, so usually a company, they're going to start off with the top line. They're going to report their revenue. And revenue is basically what they're making. And revenue can be kind of tricky in the way that it's recognized. And what I mean by recognized is when it's actually written down in the books. So a long time ago, people were committing fraud, and essentially they would do all sorts of things to mess with the revenues. So now we have all of these rules in place that really protect how you report this revenue. So for instance, if I'm going to deliver you something and let's say it costs $100, okay? I can't put that on the books until it is delivered to you. Until you receive that item, I cannot record that revenue. So this is just a side note on revenue. So let's say, for instance, our revenue is, let's just say 900. So we're just making up numbers here. Now, COGS, this is cost of goods sold. So everything that went into making this revenue. So let's say that I'm making, let's say, for example, I'm making some car toys, okay? And these car toys, they're going to be made out of wood. So my cost of goods sold is going to be the input cost of the wood and pretty much the labor that went into making that toy car. So let's say that this number is 300, okay? Now, what is my gross profit? My gross profit is essentially my revenue minus my cost of goods sold. So I'm going to go ahead and do the formula for that. All right, so my gross profit is $600. Now, what is my gross margin? So gross margin is a type of ratio. So this is going to let us know our relation between the gross profit and the revenue. So I'm going to go ahead and do that calculation. So it's literally just the gross profit divided by the revenue. And then let's just put that into a percent. So here's what this means. This means for every $1 of revenue, what I am retaining is 66.6 cents. So for every $1 I make in revenue, what I'm actually getting is 66.67 cents after I take away this cost of goods sold. So that's what this gross margin means. Now, operating expense. So operating expense is everything else. This is going to be your overhead. This is going to be your selling expense. So let's say I need a bunch of salespeople to sell this item, okay? And I have this factory. I need to pay rent. There's depreciation. There's all of these different expenses. That is the operating expense. So let's say this operating expense is, let's just say it's $200, okay? Now, what is my operating income? So my operating income is essentially my gross profit minus my operating expense. And that is $400. So normally I don't really see this operating expense. I don't really see like an operating expense ratio as much. I mostly see a gross margin ratio that people focus on. But you can definitely make a ratio for this operating expense to see how it's increasing over time. But usually what I see is gross margin. Now let's talk about income tax. So here we're assuming like 17%. So here's what we're going to do. Income tax is always going to be based off the income. So that is going to be based off this operating income right here. So we're going to multiply this by 0.17. So that's $68. Now our net profit is going to be our operating income. And then we're going to subtract that by our income tax. So net profit is $332. So they call this the bottom line. This right here, this is the top line. So this is the bottom line because, hey, you know what? We're done with the calculations. Now we could go a step further and we could talk about diluted EPS and basic EPS. Now these are actually ratios as well because it's telling us how much money we are making per share. Now let's say for basic shares, let's say we have, let's just say we have 100, okay? Now diluted shares. Diluted shares is always going to be more than basic shares because diluted shares is assuming a bunch of dilution is going to happen. Now how this is calculated, I have an entire different playlist just for this. So check it out. The playlist, I believe it's called Diluted Earnings Per Share or How to Calculate Diluted Earnings Per Share. And this is a very extensive playlist that talks about all the nuances that goes into this diluted shares. So if you want to know more about this, check out the playlist. Now I'm going to put right here 125 because diluted shares is always going to be either equal to basic shares or it's going to be more than basic shares. So those are always the two scenarios that you're going to see. Now basic earnings per share, this is essentially just going to be the net profit. And then we're going to divide that by the basic shares. Now diluted earnings per share is essentially the same thing. We're going to get the net profit. We're going to divide that by the diluted shares. So if we want to be conservative, we're always going to look at the diluted earnings per share. So this is what conservative people use. Now the basic earnings per share, I don't really use this because it's always higher. So it's basically don't use it. And the reason is because of all of the reasons how these shares can be diluted. So that's the bare minimum explanation for why I like to use diluted earnings per share over basic share. Now keep in mind that this is just basically 1 quarter. So we're just going to put 1 quarter, and let's just say that this is Q1. So this is diluted earnings per share for 1 quarter. Now we're going to have 3 more quarters after this, and we're going to have something that looks just like this for Q2, Q3, and Q4. So what we need to do to get the final year's earnings per share is add up all the quarters. So if I were to add up Q1, $2.66, then I'm going to add Q2, and let's just say Q2 is right here. Let's say that this came out to be $2. Let's say that Q3 was $3. And let's say Q4 was $4. Let's just say they did really well in Q4. Now, how do we calculate the year-end earnings per share? Well, I just told you guys, it's going to be the sum of all of those. So year end, let's just put year end right here. Now, if we want to calculate the year end, all we got to do is just sum up all of these quarters. And then that's going to give you the full year's earnings per share. And from here, you know, you're going to use this for all sorts of ratios, but you're primarily going to use it for the price to earnings ratio, or PE ratio. And I will be making a separate video about that in a different playlist, but we are not going to talk about that here in the income statement playlist. So this is part 1, and stay tuned for part 2.